Welcome, everyone. Welcome to the latest episode of The Pitch. It's been a while since I've been on The Pitch. I'm Tom Bowley, Chief Market Strategist with earningsbeats.com. I want to welcome all of you. This is really a pleasure for me. We've got three great guests today that we're going to be hearing from. They're going to be giving you some of their best ideas. And actually, I'm pretty anxious to hear what their best ideas are in this particular environment. Giving you a little bit of history. The Pitch has been now a StockCharts exclusive show for roughly 20 months. I was on the first one, and that was back in, I believe, April 2020. And I joined Grayson Rose, who I think most of you know, and Mary Ellen McGonigal, and Dave Keller hosted that day. And it was right in the midst of the pandemic. I mean, literally, we had the pandemic in March, and then we have to give our best ideas starting in April. And now last Friday, of course, we get hit with the latest COVID variant. And here I am again on the pitch. So I'm beginning to think there's some sort of a correlation maybe between me and the COVID virus or something. I'm not quite sure. Anyhow, it is a pleasure for me to be here. We've got three absolutely great guests. And I'm going to bring those guests in just a minute. We have Jeff Hughes, and we've got Julius de Kempenaer and Dave Landry. I think if you're StockCharts regulars, you've probably seen all three of these gentlemen providing tremendous information for all of us to take a look at. They're going to be here today and share some of their best ideas. So get ready, take some notes, and I'm going to bring them in one at a time. So first, I do want to welcome Jeff Hughes. Jeff is the Chief Investment Officer for JWH Investment Partners. Jeff, it's a pleasure to have you right here on the show today.
Great to be here, Tom.
Yeah, it's going to be really interesting, I think, because, you know, I've already had the pleasure of looking at everyone's picks, which I'll get into, but everything's kind of, you know, all over the place. We've got a little crypto, we got a little stocks, ETFs. So I'm really excited about this, the format today. Second up, we've got Julius de Kempenaer. He's Senior Technical Analyst right here at StockCharts.com. He is the creator of the RRG platform. I know many of you followed his blog articles and so forth. I actually use the RRG platform personally in a lot of what I do in trying to look at relative strength. So Julius, it is really a pleasure to have you here today as well.
Glad to be here, Tom.
And then finally, we've got Dave Landry. Dave is the founder of DaveLandry.com. Dave also, along with Jeff and Julius, I'm sure you've seen them a lot on StockCharts. But Dave, like the others, really a pleasure to have you here today.
Yeah, great to be back, Tom. Thank you.
Yeah, so all of you have volunteered. No one's been forced. Everyone's volunteered to share some great ideas today. I know I'm looking forward to it. I just want to walk everyone through kind of the format that we're going to go through today. So we're going to take each one of these guests. They're going to go through five ideas, five of their best ideas right now, walk you through the charts, talk about what they like about them, you know, what's kind of gotten their attention, maybe some themes that they're looking at along the way. And they're going to take about 10 minutes each to go through these five themes and ideas. So again, you're going to want to make sure you sit back, take some notes here. I think you're going to have some great opportunities, maybe some trading opportunities, up to you all. But let's go ahead and get this thing started. So we're going to start off with Jeff. And Jeff, I'm just going to let you take it away. I'll be kind of following along, pointing out the things that you feel are important on the charts that you're presenting. And so let's just get this thing started. What do you have for us today?
Sounds terrific, Tom. Let's get started with Dollar Tree and a quick explanation about our process. So we added an institutional research strategy piece known as Alpha Insights. And we are known as stock pickers. We're focused on trying to find the stocks that are most likely to produce alpha on a 1 to 3 month basis in our clients' portfolios. So Dollar Tree stands out for three specific reasons. The company is emerging from a classic pattern base formation. This is something that we spend a lot of time trying to identify these patterns because they do have a meaning, and when they resolve favorably, they can carry forward with a lot of momentum and inertia behind them. And what we're looking at here is an inverted head and shoulders base that dates back about 4 years. Now, there's an old saying that technicians use from time to time: the bigger the base, the higher in space. And we think that that's an ideal description of what we're seeing here with Dollar Tree. Dollar Tree's got exceptionally strong momentum. It broke out from what we would call a structural momentum base ahead of the stock itself. So momentum tends to lead, and it also has exceptional relative strength. The relative strength ratio has turned up positively. In other words, it's leading, and it's leading with strong momentum, kind of up and to the right. So, those factors favor this stock outperforming from an positive alpha perspective. Now, stock's trading around 142 or so as we speak. It broke out at 115, and that gives us the ability to count two upside targets. The first one's about $155. That's off the right shoulder. And the second target, the stretch target, we'll call it, is about 180. And that's from the center or the head formation. We think, trying to create a positive risk skew whenever we, recommend a trade idea, we're looking for something that can go up 3 times more, can produce 3 times the profit that it could the loss. So we always want to identify our risk on a stock. And in this case, we're going to use the average true range, and we're going to use about 2.5 average true ranges to identify a stop loss at 130. And so that should keep us in the trade as long as it favors, the strong momentum, strong relative strength. And if in fact we do get stopped out, we'll only lose about, a third of what we could possibly make. So we've got a 3-to-1 positive risk skew here. So that's Dollar Tree. The second idea I'd like to show you is a little shorter term. That's Qualcomm. Same principles apply here. We've got strong momentum. It's broken out above a structure. We've got strong relative strength characteristics that are just on the verge of taking off. And we've got a pattern that we can identify, another classic pattern base of the double bottom variety here. It's a little shorter term. This is about a 10-month pattern. It's already broken out very solidly. And we think if it continues to extend, the breakout above 160 should carry to around $200. Stock's about 180 right now. We're going to use a tighter stop because there just isn't enough upside here to use multiple average true ranges. So we'll use 1 ATR as our stop. That puts it at about 175, and that gets us a little better than a 3-to-1 positive risk skew here. The third idea that we want to present is F5 networks. F5 again is emerging, or has emerged, I should say, from another classic pattern base formation. This is a 3-year cup and handle base formation. The stock again has good, steady positive momentum, but it appears to be emerging from a structure, a pattern structure. In this case, we see, a 5-point symmetrical triangle. It's broken out. It is pulled back a little bit. That's not uncommon. But if it continues to remain positive, we like that characteristic. The relative strength is also turned positive with accelerating momentum. And so we think those two features support this pattern carrying out. So the breakout initially at 200 and then secondarily at 212 gives us the ability to count a target to around 255 off the handle and 320 off the cup. So with the stock trading around 227 right here, we can use a pretty generous stop loss or risk budget. And we're going to use 3 ATRs, which gets us to about 210. The stock takes out 210. There's a good chance we've got more consolidation ahead of us. And so we'll be out of the stock. But if it works out, it's a 5-to-1 positive risk skew here. The fourth idea I want to present is an oil stock, Chevron, CVX. Chevron is emerging from a classic bearish to bullish reversal pattern, also developing as something of a cup and handle base formation over the last couple of years. Now, in our opinion, if in fact we do see the follow through here, this breakout above 115 should carry, or above 112, I should say, the stock's about 115 as we speak, should carry initially to about 133 and then ultimately to 173. So just using that initial target, we'd come up with a 3-to-1 positive risk skew by using a stop loss at $110. That 110 is approximately 2 average true ranges. So, again, a tighter stop. If it fails, we don't want to give this one too much room. We only want to own the stock if it's above those trend lines sustainably. The final idea I would present to you is another shorter term trade idea. This is WW Granger, symbol GWW. Stock went out about 489. It broke out a couple weeks ago at 461. That breakout of an intermediate term base formation dating back about 6 months gives us the ability to count a measured move to about 570. Now, 570 gives us plenty of upside here, but we want to give ourselves a risk budget of around 460. That's 3 ATRs below the last trade, and that locks in a 3-to-1 positive risk skew on this name as well. So those are the 5 names that I'd be focusing my attention on right now.
That was awesome. I'm a pattern trader as well. So definitely looking at these, I can see exactly what you're looking at. I do have a question for you though. Do you use volume? Do you require heavier than normal volume on breakouts? Is that something that's important to you, or do you strictly base your analysis on price action?
I don't trust the volume that's reported. There's a lot of unreported volume in the dark pools, and I'd rather give that to momentum. If I see volume confirming, then that's just a bonus for me. But I'm not going to weigh. I'm not going to put too much weight on the volume if it isn't there. I'd rather just tighten up my stop. And as long as I've got that positive risk skew and the momentum's positive and the relative strength is either very positive and accelerating or has turned up aggressively, like in the case of Granger here, we're seeing that relative strength really hasn't even taken into the leading quadrant yet, but it's turned up aggressively, and the momentum of that relative strength rotation is accelerating aggressively as well.
So you wouldn't wait then for the relative strength to turn? I mean, you're aware of it. Obviously, you manage your risk, which I think is so important to anyone that's trading the market. But that doesn't bother you either, as long as you're starting to see that momentum and you've got the pattern breakout. That's enough for you.
Yeah, it's enough to make the buy list, and then it becomes an execution, a function of execution. Am I going to scale into this over time? Yeah, am I going to go all in, feet first? Probably not in this name. I'd probably give it a little room to breathe and scale in over a few days or weeks and just kind of continue to watch that relative strength and make sure that it makes progress. And if it doesn't, we'll probably get stopped out quickly. That's one of the things about this system is, your mistakes are, identifiable quickly, and you just move to the sidelines and go to the next idea.
Okay, cool. Well, these were 5 great ideas. I've got some other questions, and I'm going to save some of those for a little bit later in the presentation and in the show. But we're going to go ahead and move on, and we're going to bring in Julius de Kempenaer. Julius, it's been a while since we've done a show together, but always a pleasure to have you on here. What do you have a theme? Before, getting all of your charts ready here, but do you have a theme, in what you're going to be talking about?
Yeah, there's always a little bit of a theme, I guess. I mean, my storyline, my narrative for today's show, I want to start off at a macro level, basically looking at asset class rotation, and then dive into sectors and groups and eventually pick out. I'm going to go for 4 stocks, and the other one is more of a macro play.
All right. Well, I have seen your slides, and you've got a ton of information here. So you're going to have a challenge to get through this in 10 minutes, but I have confidence in you. Take it away.
We're going to go quickly. Yeah. So here's the title. You can skip that one. That's not a problem. Here's the first RRG. This one shows you the rotation of various asset classes. If you've seen my show, Sector Spotlight, every Tuesday, you've seen this chart. What I want to focus on here today for the pitch is the rotation for stocks, which is ITOT, that's the total stock market index on the right-hand side in that green area. that is rotating from weakening into leading, and then we know that that is a strong rotation. And on the left-hand side, where you have a group of fixed income related asset classes, so it's GOV, high yield, and corporate bonds, and you see all of those are rotating from improving back into lagging. So for me, this means that the relative strength of stocks over bonds is picking up again. And if we move to the next chart, then I've highlighted that relationship, basically using SPY and IEF, because I think those are probably symbols that a lot of people are well aware of. And the base that I'm looking at, and Jeff already mentioned big bases, and I think the big base, the big signal that we got here was back at the end of 2020 when we broke out of that big base. Now, in relative strength, you can apply the same tools as you can apply to any other stock, like all the TA tools that we have. So the height of that base is around 1.2. And if I add that to the breakout level, which was around 3, I come to 4.2 as a target. We've sort of seen that, not quite yet. We ended at 4.1. But the trend here is still intact. And what I always ask myself is, where is my opportunity? Where are my risks? Where are my opportunities? And with relative strength, that's a bit of, it's difficult to actually make that up in your mind because you've got two moving targets. But if you move to the next chart, then there's a table, and I call that reverse relative strength. And what you see here is on the vertical axis, we got the price of SPY, and on the horizontal axis, we got the price of IEF. SPY currently is about 460. And IEF is around 115.5. So the relative strength, the raw relative strength number that belongs to this combination is 3.98. That's right there. Now the vertical and the horizontal bordered columns are the support and resistance levels. And they're not exact numbers. They're sort of like, this is in the resistance area. So where you are right now, 118, that's a resistance area in IEF, and 113.5 is a resistance area, a support area in IEF, and 450 is resistance in SPY. Support in SPY, and 470 is resistance in SPY. The shaded areas show you where support and resistance in relative strength comes in. So if we can't put them side by side, but on the previous chart, you will see that 3.7, 3.9 is where your support comes in for relative strength, and 4.2 was the upside, but beyond that, because it's uncharted territory, you got a lot more. Now, if you flip back to that table, then you can see that if we move higher on SPY and lower on IEF, you got the big green area. That's good. That's what we like, because you got a lot of strength in stocks over bonds. And the reverse goes when we move the other way. This table helps you to identify the levels where both SPY and IEF need to move to keep that uptrend in SPY and IEF intact. That's basically what it's doing. So 3.98, like 4 is where we are right now. As long as we stay above 3.7, 3.9, preferably 3.9, but 3.7 will do, that uptrend in relative strength is intact. And as long as that happens, I'm going to prefer stocks over bonds. So that's the story on a high level macro play. Now, when we move to sectors and flip to the next chart, which shows you the RRG, at the moment, I think there's 3 sectors that are worth our attention. And the first one is technology, because it's rotating from weakening back into leading. That's a strong rotation. We know that. Energy and discretionary are strong sectors, but as you can see from those long tails, they've already run a big part of their course. So I'd like to look at sectors that still have a lot of potential in them. And then I come to materials and industrials. Both are in the improving quadrant, but they have a very nice RRG heading, which means that they're gaining on both axes and they're moving towards leading. So what I'm going to do next is I'm going to dive into technology, materials, and industrials in that order as well, because I think that technology is the most reliable because it's moving from weakening into leading. It's already a relative uptrend. And then materials and then industrials, because the risk is increasing the further we go to the left. So if we start with the technology sector, and if you can bring up the next chart, Tom, I'm going to look at, and I've pulled this chart, only those two groups on there. There's a lot more, but I wanted to highlight those groups because I think they have interesting rotation. So that's computer hardware, inside weakening, rotating back up, and there is electrical components and equipment that's coming from improving and moving into the leading quadrant. I think those two groups, inside technology, offer good potential going forward. Now, if we go to the next slide, then the first stock that I want to pitch, so the first one was the macro play. Now this is my second pitch. That's Seagate, STX. If you look at the chart, you can see that that uptrend is still there, and we've just broken above that previous high. We rallied, and we're now testing that breakout level as support. So that looks like a pretty good entry point to me, with your stops just below the support level. And as you can see, I'm using the same relative strength, the RRG lines below my charts. There's Jaffis, there's no surprise there. But you can see that both are moving higher, which is good. And that's putting STX right at the verge of pushing into the leading quadrant, which is what we like to see. And the second one here on this group is TEL, TE connectivity. Sort of similar chart, very nice uptrend, small consolidation, break to new highs, now dropping back. I'd like to pick this up, let's say between 155 and 160 with a stop loss just below that support level. Raw relative strength, which is the one just below my price chart, has broken out as well. And you can see the RRG lines are trying to pick up that new uptrend. They're emerging. But you can see if you go back in history that RS ratio line, the red one, has plenty of room to the upside to push TE connectivity higher with limited risk, in my opinion. Now, the next one is from the materials sector. That is non-ferrous materials. And you see the tail here, it's inside the improving quadrant, quite a long tail, which means that there is a lot of power behind this move. And if I zoom in, and there's no time to go into all the individual RRGs, but we could, what I've done is I've thrown all the members of this group, non-ferrous metals, on an RRG. And I came to the next chart, which is, if you flip to the next, yes, to HAYN International. As a matter of fact, what's the other one in this group? FCX is the other one. And FCX and HAYN are looking similar, but FCX is something that a lot of people look at. So I decided to go with HAYN. At least for me as a European, a less well-known stock. Maybe it's different for you guys. But I like this chart. It's a very nice uptrend. We broke to new highs, and it looks as if that RS ratio line at the bottom is putting in a new low well above the 100 level, which is creating that rotation from weakening back to leading. So we're basically starting to put in a new up leg in an already existing relative uptrend. Combine that with the breakout in price, and I think we've got a good opportunity here with a bunch of stop loss levels possible between 40 and 42. So that was that one, and then we go to the last one, and that is the industrials group. And if we flip to the RRG, then you can see the rotation of the railroads, very nicely putting in that rotation from improving into leading, has just crossed into leading. So theoretically, still got a lot of potential to move through that leading quadrant. And if you throw up all the railroad stocks on an RRG and compare it to whatever you like, SPY, XLI, or the railroad index, the one that I found most interesting is my last pick, and that is CSX Corporation. Again, very nice uptrend, and that I like those breakouts, especially when they test that breakout as support. And it already did that last week. It's holding up very nicely today. So if that continues, you got a very good profit to loss ratio there. And if you go to the relative strength stuff, then you see that The RRG lines are now already both above 100, still pointing higher, which gives us a good RRG heading and a strong move into the leading quadrant. And that concludes my 5 stocks.
You did it.
I did it. Was it
You
within
got
10
through.
minutes?
You got
Nice.
through in roughly 10 minutes, which I'm actually shocked after I looked at it, all the information you were going to be presenting. But
You know what? I had my timer, but I forgot to, I actually forgot to start it.
Well, hey, that's what happens with these shows. You know, you just got to roll with the punches. No, you did a great job. And, you know, the thing I'm seeing already, of course, we haven't gotten into Dave's picks, but I'm already seeing, you know, when I look at the consistencies between how you analyze the stocks and what Jeff did when he was analyzing his picks, we're getting a lot of relative strength. We're getting a lot of charts that are moving from left to right up. We're getting momentum. And so I'm going to have some questions about that later. So stick around. But we still have Dave Landry to close out the 15 picks. Dave's our closer today. So Dave, while I'm getting everything ready here, why don't you, you know, do you have a theme, you know, in picking your stocks here?
My theme is trend, and my theme is using trends to find themes, not the other way around. And we'll get to that in 1 second. But I think the underlying thing is that the trend is going to tell you where the themes are, as opposed to just the opposite.
Okay. All right. All right. I'm getting you set up here. 1 second, and we're going to be set to go. All right. So you've got 5 picks, and yours are a little bit different in terms of what you know, in the direction you went, but I'm going to let you talk about it. What do you have for us today?
Okay. Just a quick story real quick. Many years ago, someone who I really respected, and it was done anonymously, but I know it was him. He called me a trend following moron. And the reason he did that was I was plotting charts and drawing big blue arrows on the chart just because my Photoshop defaulted to blue. And I'm known for drawing the big blue arrows. But anyway, he was shorting the same stocks that I was going long, and he got very upset with me, and he called me a trend following moron. And somebody I really respected, and I was hurt at the time, but then the name stuck, and then my clients call themselves, a lot of them, fellow TFMs. Anyway, long story endless, through becoming and embracing the trend following moron nature of things, just buying things that generally go up, usually on pullbacks, except for occasional breakouts, and I'll explain that in 1 second. As I was just saying, sometimes you can find a theme as opposed, the theme will find you through the trend. And I think that's the bottom line. And it is quick example, it was about 1.5 years or so ago, I picked ASO, Academy Sports, and it was hard to buy a brick and mortar company at the time. But it turns out that people wanted to get outside and they were sick of being inside and started buying kayaks and such. And the stock has turned into one of our biggest winners of the year. So with all that said, if you take a look at this meta, I actually had to look up what metaverse was. I had an idea, but I wasn't exactly sure right before the show. But look at the bottom of the chart. This green indicator down here just tells you the number of days that the lows are greater than the moving average. I call that Landry light, and that's in the ACP platform. And one great pattern is waiting for a stock or other market to pull back to that 30 EMA. And I call it a Landry light pullback. So in this case, this meta entry maybe about 16.5, a little bit higher, give it a little wiggle room on that, easy for me to say. And then maybe a stop around 1550. Now, what's interesting about this metaverse thing is I've been seeing a tremendous amount of opportunity in crypto. And right now I'm long Hero, Fear, CGG, and Sand. And I've taken profits and banked a little bit on a lot of other of those game-related crypto stocks, which all sort of fit into this meta universe. So just by doing my scans on Friday, I found this meta, and I find it kind of interesting, and that might be a play to get you into those stocks. So let's go to the next one. One thing I'm a big fan of is inefficiency when it comes to stocks or any other market for that matter. And right now, the crypto, especially the altcoins, are super inefficient. And another place where you can often find inefficiencies is in IPOs. And inefficiency means that everything is not priced in. Some of these cryptos will go up 100% overnight. Obviously, S&P is not going to go up 100% overnight. It might go up over time, but certainly not overnight. At IPOs, they heat up and cool off, but right now IPOs are doing pretty good. They're coming back at least. And this is what I call a first deep retracement. Notice that the stock ran up fairly sharply. Sometimes these IPOs get a little ahead of themselves, and then they have a deep correction. So again, we're looking to play the pullback here and looking for maybe an entry around 27.5 or so, maybe a little bit higher, depending on where the stock ends up today, or a little bit lower, I should say, if it keeps pulling back in here. So let's go to the next stock. Now you can see, once again, we have a lot of Landry light in here, meaning the lows are greater than the moving average. And you can see a visual representation of that on the bottom. I don't use a lot of indicators. So my indicator pack on StockCharts, which is free, by the way, is actually more of a what I call an illustrator package, or illustrators to help illustrate what's actually in the chart. And you can see this stock is at a nice run up. It's got a lot of Landry light, means the momentum is there. And then it didn't pull all the way back to the 30 EMA, but it pulled back fairly deeply based on the magnitude, based on getting stretched away. And I am long this stock, and my clients are actually long this stock too. This was a recommendation a few days back, but I still think it's viable. Maybe around 20 or so would be a good entry on that. And then this is a pretty volatile stock, so you probably would have to give it a lot of room. Maybe stop out way down at 15, believe it or not. And that's what it calls for, quite a bit of wiggle room on that one. So let's go to the next one. So this is a crypto pair, and I'm actually long this one too. And the beautiful thing about crypto, there's two great things about crypto right now, especially the altcoins. One, extreme inefficiency. And I was talking to Julius before, and I'd like to learn a little bit more about RRG and some specific concepts such as delta relative strength. But right now, a lot of times you could just simply buy the strongest pairs and set a profit target and have a stop in place and just kind of hold on best you can. And just wonderfully inefficient market right now. But the other great thing about them is my core methodology works really well there, especially since the market is inefficient and trending so well. So the stock like this one, or I should say a crypto like this one, you can see you've got a longer term uptrend as evidenced by the Landry light down below. And you've got a very orderly pullback. Now I've been in this one for quite a while, but it's set up again. And that's why I'm showing it again. And maybe enter around 125, a little bit more aggressive, might be a little bit below that. And you could stop out right around that 30 EMA. And the great thing is a lot of times these things go so fast, you don't have to be quite as liberal with the stops. In stocks, I tend to be a lot more liberal with the stops, but these things are like a bus. Another one comes along every 10 minutes, and sometimes another one comes along every 5 minutes. And I don't know the guy's name because I don't watch CNBC, but one of my clients was telling me that one of the guys, not Joe Kernan, but the other guy, sidekick, was saying that we're either in 1996 with these cryptos or we're in 1999. And I think we're probably, I'm hoping at least, it's a word you should never use in this business, but I'm hoping we're in 1996 or 97. And it sure looks like that so far. And let's go to the next one, Tom, CRO. So one of my favorite sayings is, don't confuse the issue with facts. But when they rename the Staples Center to crypto.com, that's just a little bit more evidence, at least to me, that crypto is becoming more and more mainstream. And I heard somewhere that only 4% of the people in the world actually trade crypto. A friend of mine, he used to work offshore up until very recently. And he was telling me that at night, instead of hanging out, all the guys go back to their rooms and they're trading crypto on the phone. And these guys are paid very well. Some of them making 200 grand a year, and they're kind of very meager in their living expenses. So they have plenty of money. So that excites me that a lot of money is coming into this market. Now, this is a little bit of a shallow pullback. I am long this one. I've been in and out of this one quite a bit. I'm still long this one in longer term trend following mode. But once again, you can see you've got a nice longer term uptrend as evidenced by the green down here. This is Landry light, so it's headed higher for quite a while. And then in a case like this, I wouldn't wait for it to pull all the way back to the moving average. Instead, since it's made a somewhat shallow pullback, I think it looks pretty good in here. Maybe an entry right above, a little bit higher than that. I can't read the actual numbers, maybe about 78 cents or so. And I think that this one has the potential to keep on heading higher. So bullish on the altcoins right now. I think there's a wonderful opportunity there. especially in the I can't say the word that most traders call them because it's a PG-13 show, but especially in the thinner ones, such as those game related ones, those things can really move. And sometimes I'll get in those and within 5 minutes, I'm hitting that IPT, not all the time, but every now and then. So that's my pitch for today. Follow the trend and let the trend find the themes for you as opposed to the other way around.
Awesome. Well, definitely there's a theme here between the three of you with momentum, you know, to some extent, relative strength. We've talked about quite a bit here. The other thing that I've heard quite a bit is managing risk. And I think for me, you know, I don't know what everyone's, every individual trader's, their approach or their strategy is, but I do think that one thing that a lot of folks don't consider enough is the fact that you've got risk to consider. It's not just buying and hoping something goes higher. You've got to be anticipating that a trade could go against you. And so I'm really impressed with all three of you making sure that you have your stops identified.
To your point, Tom, I think that could be the holy grail of crypto. In fact, I might need to write that down and do a presentation on that. The aforementioned people that I talked about that are playing on their phones and everything, those greater fools, so to speak, they have no risk management. And I think that if you could apply a heavy dose of money management, I know money management is not sexy, but I really think the money management could be the holy grail in crypto because I'm getting like right now, 20% profit. I'm getting my stop to break even, taking half of those shares off. So it's a free ride, so to speak, and establishing a lot of free positions. And it's just been a blast. And I think money management is the holy grail here.
Yeah. I have one follow-up question here on the chart, or maybe just a comment. Because I'm not familiar with the Landry light. I think this is a great visual, though, for folks to look at. And I know on the ACP, you have this as a free plugin that people can download and use ACP with this signal. But just clarify, this goes up a little bit every day based on the number of days that you're above that 30-day. The low is above the 30-day.
Right. It's not magnitude. It just tells you how many days. It just counts the number of days. So right now it's kind of hard to see, but it looks like 32. So for 32 days, it's been above that moving average. And you can see to the left side of the chart, when it was headed lower, you start getting that negative Landry light. And if you're getting green and red or green and neutral intermixed, it's just bouncing around the moving average. And that might be a time you want to stay out of the market. And what happened? This all stemmed from, I did an article in 1996, I think. I know I'm dating myself. And it's called a 220 EMA breakout. You're just looking for 2 days above the moving average, two green bars, and then you enter above that 2-bar high. So if you go straight up from where you are to the right, that would be a signal right there. That would have been a buy signal right there based on that system. And that's just a little breakout system that's working really well. Anyway, one of the guys who read the article wrote to me, and he called it daylight because you can see light in between the bar and the moving average, and we just call it Landry light now.
Awesome. All right. Well, you all three shared some great ideas for everyone watching. Definitely appreciate that. Now we're going to move into a different part of the show where I'm going to have a couple questions for you, and I really just have a couple big picture questions I wanted to talk about because Friday was a really rough day. Last week when got news of the new COVID variant, the Omicron or whatever the heck it's called, but now we got a new one to deal with. And of course the market didn't like it at all. So all of you are looking at momentum. You all have some great picks that you've shared, but if I pull up, for instance, and I'm going to go ahead and just use my charts now, maybe we can all work off of this, but if I pull up something like the S&P 500, how important is it in your analysis? And you can go in any particular order, whoever wants to take the question, maybe everybody can chime in a little bit, but how important in your analysis is it what is going on in the overall market? Do you only consider yourselves with the stocks and their momentum, or does the overall market matter? In other words, when you see a down day, big, heavy volume down day like we saw on Friday, how much does that impact, whether or not you're going to put on new trades and so forth? Anybody want to take a shot at that?
I'll go ahead if you want. No, Julius, go ahead. Go ahead.
Yeah, well, I mean, very briefly, I mean, from the way I attacked this market in my pitch, you can see that I use a top down. So the overall market is extremely important in the resulting, stock picks at the bottom of the pyramid. So yes, it is important.
All right,
So
Dave.
yeah, what I'm doing, Tom, is I'm going through about 2,000 stocks every night. And I'm also looking at quite a few sectors to see what's happening there. And of course, the indices. And what I found is as the market weakens like it is because of a pullback player, I actually get more setups. But if the market stays weak, I'll get less triggers. So as I said earlier with the inefficiency, just to cover that real quick, something like an IPO, I'm not as worried about the overall market. And then in everything else, usually waiting for an entry, not all the time, but sometimes it'll keep you out of trouble. So I've got 3 setups coming into today, and maybe none of them will trigger. And that in and of itself will keep me out of trouble. Now, if the market does begin to roll over, as it did last year, obviously, then the database, I'll start seeing a lot of shorts setting up, and then I'm not afraid to short. Not my favorite thing to do, not the easiest way to make money, but as a trend following moron, I'm kind of stuck following the trend lower. So I let the database speak. Sometimes I'll find a stock that looks great, even though the market conditions are crappy, and I'll go ahead and take it. But for the most part, the database will give you fewer and fewer setups. And if you can't find a long to save your life, then you probably don't want to be trading the upside.
Awesome. And Jeff, basically the same question, but I'd also maybe add a little question. Is there something that you look for in the overall market? A sign, is it the 50-day moving average? Is it on a weekly chart, the PPO going negative? Is there anything that you look at where maybe you'd start to get signals where you want to kind of really tone down the investment or maybe start to raise some cash? What do you think there?
Yeah, 2 things, I think. Number one, we try and look at the market based on its longer term and intermediate term trend. And we identify key support and resistance levels. And we stick to those key support levels. If those levels get broken, then we'll dial back our exposure, okay? And we do it based on degrees, right? So, we've got kind of an initial support, an intermediate support, and a longer term support. And so, as we start taking those levels out, we'll be dialing back our exposure by about a third. Now, the second thing I would say is that, there's a great signal, and I'll give you a perfect example. Friday, we saw a huge flush in equities and oil. A lot of commodities down, but oil was down dramatically. And I think, through yesterday's close, it's down maybe 18.5%, or Friday's close rather, 18.5% month to date, right? Having said that, Chevron is still trading near its 52-week high, just off a couple of points from its 52-week high, held up much better than the market. And so when I see the tide go out and names with very high relative strength and very high momentum, they tend to stand out. You can see what the leadership names are when the market flushes like that and they don't go down. Then I pile into those names. Those are the names that are likely to go up. And what makes stocks go up? Institutional buying, okay? It's not my opinion or Julius's opinion. It's not a trend line per se, but it's the aggregation of institutional money that's flowing into these stocks. And what are they chasing? They're chasing relative performance. They need to beat their benchmark. And so it's that high relative strength, high relative outperformance names that continue to get an institutional bid that will continue to accelerate higher while everything else is flowing out.
Yeah, that was actually a great point. One of my favorite things to talk about in the stock market's relative strength. I think that is so important. And I know most of the folks at StockCharts, the other, all of our colleagues at StockCharts that write and do shows and so forth. I think that's, if there's one commonality between just about all of us, I think it's relative strength. And so I think you raised a great point there, Jeff. I mean, we saw Friday, if I go back to that WTIC West Texas chart, I mean, you can see crude oil on Friday absolutely got crushed to the downside. And, most folks would see the XLE dropping. They'd see a lot of oil stocks dropping. They wouldn't really take anything away from it, except that stocks are falling in that area. But I think you raised a great point. When you look at something like Chevron, it's up near a high, even though crude oil has been dropping so precipitously. And maybe this leads me to my next question for the three of you, because I'm a fan of the accumulation distribution line. And I can see with CVX, it was kind of weak for a while, but starting back in September, as price action was moving up, you can see this accumulation distributions also following. Do you all have any indicators, whether it's AD line or any others? Do you have any other indicators that you follow in terms of trying to determine whether a stock is being accumulated? Obviously, if it's going higher, it's being accumulated, but are there any other signs that you look for, any other indicators? Anybody want to test?
I'll just carry through, since we're talking about CVX here. I don't use any indicators per se, but price is the final arbiter, right? And so price in and of itself is an indicator. And if it continues to make new highs or hold above prior lows, that's an indication of accumulation. You know, in the 90s, I worked as an institutional trader at Merrill Lynch, and I handled, you know, multi-million share orders for big institutions. And I watched how they brought these in, and the communication was, you know, we need to get this filled. We're going to work it over 4 weeks. Okay. And, you know, we would watch sellers come in, and they would, as soon as it broke the VWAP, you know, these guys would just turn on the volume. They would suck up every single share like a vacuum cleaner, but they would hold it above some sort of a key level because they didn't want too much selling to come in. They didn't want to create footprints all over the marketplace. So they tried to, you know, maintain this sort of even keel and just suck up all the loose volume. At the same time, when you get a flush like this, and it was an obvious opportunity to complete the order, they would also jettison all their weak stocks at the same time. And so we'd get, you know, 20 orders of stocks that they just wanted to, you know, create. You know, it was the source of funds to accumulate the one name that they did want to own. And so that's how it works in reality.
Okay, awesome. How about, you know, Julius or Dave? I mean, do you use the AD line, or do you look at any other signals that might help you with accumulation or distribution?
I don't use any indicators whatsoever other than the occasional moving average. I always start with a blank chart first. And I think, as Jeffrey hinted to, price is the ultimate oscillator. It's either going up, down, or sideways. And I'm a firm believer in accumulation. Obviously, if it's going up, it's being accumulated. If it's going down, it's being distributed. Distributed. Now, in some cases, the distribution can create an opportunity. I have a pattern I call a trend knockout, where something's really trending and all of a sudden it just gets absolutely creamed. You look to buy above that high, and that can be because maybe some of those buyers have gotten flushed out. And if it keeps dropping, you just stay out of the way. So I'm still waiting for that price to improve after that occurs. And a lot of stuff I'd like maybe talk to Jeffrey offline, but a lot of things he brought up make a lot of sense, because one pattern I like to trade, I'm not a huge day trader, but in the end, I'll take an intraday trade based on an opening gap reversal, because I know in some of these big names, just the opposite of what I trade normally, some of the ones I showed earlier, some of these big names, I know they want to accumulate them, especially if it's going up. And I think that gap down gives them an opportunity to do so. And I hope I'm right on that, because it seems to be, not all the time, it seems to work really well when it does work.
Awesome. Julius, any other comment there?
Yeah, it's getting a little bit boring now, because I also don't really use a lot of indicators. I use relative strength. I mean, that is, you could say it's an indicator, but I also think it's a way of looking at markets. Indicators are sort of secondary. So if I just look at a price chart, I'm not interested in relative strength, I use a standard RSI and MACD. That's just, you know, I don't know. It's pumped in during training, and that's what I use. From an RRG point of view, you mentioned AD line. That is a breadth indicator. So I love breadth, especially because on StockCharts.com, we got a lot of breadth data that are tailored to sectors. So one of the things that I've been playing around with is plotting breadth data on RRGs. And I've done that for the AD lines, but what seems to be giving me some secondary information and sort of early warning is plotting the indexes for every sector, that of the number of stocks, or the percentage of stocks trading above their 20, 50, or 200-day moving average. So we have series where StockCharts calculates the percentage of stocks in a sector trading above their 20-day moving average, their 50-day moving average, and their 200-day moving average. And when you plot those on an RRG, sometimes you get some very interesting early warning signals showing up. So I've just pulled up one of these on my own system, and it's a little bit of a hassle to do it right now. But one thing that and I hadn't looked at this chart for a while, but what stands out is that the utility sector, so the amount of stocks trading above the 50-day EMA in the utility sector is actually pushing really hard into the leading quadrant, which means that there is under the hood a lot of things going on that utility sector. So with all that bullishness in my head, I need to make a fact, because this is a very defensive sector. And this defensive sector, all of a sudden, a lot of stocks are trading above their 50-day moving average, more, because it's all based on relative, more than in the other sectors, which is something that makes my head spin.
Okay.
Right now.
Well, I got one last question, and we're going to wrap this up. Again, thank you to all of you. These are great discussion, great ideas. But if I said you got to select one answer or the other, we're sitting right now. The S&P 500 is up nicely currently, but it's up. It's 4670 area right now. Do you think we hit 5,000 between now and say in 2022? Do you think we keep going up? Do you think we get above the 5,000 level on the S&P 500, or do you not have an opinion or don't care? What would you all say to that?
Well,
I have an opinion.
Go ahead, Jeffrey.
Yeah, go ahead.
Sure. So, we publish a target, and we arrive at that target with, a variety of different measured move effects and things like that. Our published target's 4,800. We don't have a timeline that we have to hit it by. Like, it's not a year-end target per se, but it wouldn't surprise me to see us hit it by year-end, or exceed it for that matter. We've got some Fibonacci-derived targets that can get us into the 49 and change level. And then we can get into kind of some, more arcane sort of target generating math, like the rule of 7, for example, which gives us some really potentially high targets looking out, maybe in the 12 to 18 month time horizon or beyond. But, from my perspective, those upside targets on a long-term basis don't preclude the market from going lower first. Sometimes the market needs to kind of, regenerate the energy. It needs to consolidate the existing gains. And it doesn't necessarily mean that we have to have a 2020 like market plunge. We might see a sideways trading range develop over the course of many, many months before we get a big breakout. A good example of that was in the Russell 2000. You saw 10 months of sideways trading before an explosive move to the upside, and it's already checked back to kind of the origin of that breakout. And it, remains to be seen whether or not that's the end or whether there's more upside. We actually believe small caps are going to lead large caps, but we're not looking at the Russell 2000 so much because a third of the stocks in the Russell 2000 have no earnings. And they haven't had earnings for 5 years or more. So we like to look at the S&P 600. This is more the quality element of the small cap realm. And I guess the answer to your question is, yeah, I think there's additional upside.
Okay. Dave, you got any thoughts on this? Maybe have another 30 seconds or so.
Yeah, I was sitting next to Greg Morris one time, and he said all predictions are about the future, and a lot of stuff can happen between now and then. He didn't say stuff, but anyway, I think a lot of stuff can happen between now and then. For now, I'm bullish as a trend follower. I'm going to follow it up to 10,000 or wherever it goes. But if it rolls over, I'm just going to follow it down. So yeah, for now, I think it's still headed higher, but that could end soon. Check back often.
Okay. Julius, you're going to get the last word on this. What do you think? You bullish or bearish?
You already said it. I don't care. But with a gun to my head, 5,000 in 2022. Yes, that I think that'll happen.
Okay, awesome. Well, I want to thank all three of you. First of all, for taking all your time out, not just for today, but I know it takes time to go through, come up with your selections and be willing to share all that with our audience. So again, I want to thank all three of you. It's been a pleasure having Jeff, Dave, and Julius on the show today. They've shared a lot of their knowledge, their experience, and some of the things that they're looking at right now. So again, thanks to all three of you. Really appreciate it.
Thank you, Tom.
Thanks,
All
Tom.
right. Yep, that is it for the pitch. Again, I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's been a pleasure, not just to be on the show, but to be on here with three good friends and excellent guests presenting some of the ideas that they wanted to share with you today. So I will just go on record with them and basically say, I believe we're going over 5,000. I think it could happen this year, but I think it's probably more likely next year. I see the market going a little bit higher over an extended period of time, but we're all trend followers. So in the end, really, we just want to see what the charts are telling us, not really necessarily predict, but follow those trends. So with that, again, thanks to everybody for tuning in. We really appreciate you being a part of this, not just this show, but the StockCharts TV in general. So until next month with The Pitch, I'm Tom Bowley, wishing everybody a great rest of your day. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.